Hey everyone, welcome back. So today is Saturday. Obviously we had a pretty bad week in the miners and Bitcoin in general. So we'll take a look at obviously how they performed for the week, see which ones did better than Bitcoin, see which ones did worse. A lot of them did worse than Bitcoin, which was kind of foreseen. We'll also take a look at an article that I read just today, this morning. It was kind of interesting that it's talking about the inflation and how it's possibly going to be with us for as long as 2 more years. And we may see inflation as high as 6%, month over month. Not month over month, but CPI data being basically 6% or higher. So that's kind of interesting and also kind of scary. So we'll take a look at that. So as always, not financial advice. Do your own research. Don't fall for scams. Spam posts get reported and deleted, and the companies I'm invested in and coins. So let's take a look at Bitcoin here really quick, and then we'll take a look at the other information on the miner stocks, see how they did. So Bitcoin right now is at 40,124. Hasn't changed much from yesterday, obviously. We're still kind of trading sideways here, but the concerning part for me is always the RSI. RSI is going up even though we are trading sideways here for a while now. This is on the 1-hour chart, and I would like to see, obviously, RSI go down while the price goes up. But right now, if we look at it here, the RSI on the low here was back on the 17th. So this was yesterday. And we hit a pretty low RSI, which was right around 40,700 or so. And you can see from there, the price has come down while the RSI has gone up. So that's always a concern for me. In the short term, I think we may be falling a little bit more. And then obviously, if we fall more, we're probably looking at the 37,500 mark or so. This could be our possible next support here. And then obviously right now, the 40,700 line is basically acting as our resistance. So we'll see how this plays out. But right now, it's not looking too good on the 1-hour chart. On the daily chart, it's looking a little bit better, but still not great. RSI has obviously come way down, so we have more room to go up if that happens, but we also have obviously more room to go down as well. So we'll see how this all plays out. We'll see what the tension is with Russia and Ukraine, see what happens there. Obviously, that's fueling the dip here in the last couple of days. If we take a look at Ethereum, Ethereum is doing the same thing basically as Bitcoin. It has come up, it's come down right now. RSI is still relatively in the middle at 42. Not much going on there. Everything's basically following suit of Bitcoin and general market in general. So we won't dive too much into it. But overall, we'll see how this plays out over the weekend. Obviously, like I said, the RSI on the Bitcoin chart, on the 1-hour chart, doesn't look good. So I think we may be coming in for a little bit more of a downtrend here before we bottom out completely, maybe. Hopefully, we'll see. Fingers crossed on that one. All right, so let's take a look at the miners here, see how they did compared to Bitcoin for the week. And then we'll get into the main story here, which is kind of interesting. So we'll take a look at that. So Bitcoin obviously finished out the week down 2,376. It was down 5.6% on the week. So I'm doing Friday to Fridays, right? So that's how that's being calculated. And then Argo was down 4 cents on the week to down 4.19%. Bitfarms was down 45 cents, down 11.5% roughly. Cleanspark was the only one that was actually up on the week. It was up 23 cents or 2.64%. Core Scientific was down $1.94, so it was down 19% roughly. Digihost was down 75 cents, so it was down also 19% down on the week. DMG was down 5 cents, so almost 10.5%. And then we got Hive was down 11 cents, down 5.25%. Hut 8 was down $1.19, so it was down 16.75% almost percent down. And then Iris was down $1.24, down almost 8.5%. And then we got Marathon down $3.04, so that was 11.25% roughly. And then we got Mawson down $1.11, down 24.25% down, so that was huge. So they're the biggest loser on the week, obviously. And then Riot was down $1.40, was down 7.62%. So a tough week for the miners, obviously. Started out looking like it was going to be a pretty good week, but it ended up to be a pretty terrible week in general. So we'll see how that plays out this week. Hopefully we have all the negative stories out already. So if we look at the chart here on the weekly, we'll take a look, see who did better than Bitcoin and who did worse. And then we can see obviously on the chart here that Mawson did the worst, followed by Core, Digihost, and Hut 8, followed by Bitfarms, Marathon, DMG, Iris, Riot. Then we got Bitcoin down 5.6%, and then Hive was down only 5.3%. Argo was down 4.19%, and Cleanspark was the only winner in the week. So That was actually good to see. Obviously, they provided good numbers, so I keep saying that in some of the videos, but they did provide good numbers, so I think that's what's keeping them up a little bit more so than the other guys. Hive did great too with their numbers for Q3 that reported at the end of December 2021, sorry. And I'm surprised that they're not going up higher. It's just the way it is. Let's take a look at the 4-week chart here, see how we're doing on that. Obviously, on the 4-week chart, we have a lot more green on it than we do red, which is good to see. So we'll do that descending, see how those guys played out on the 4-week chart. And on the 4-week chart, we can see that Bitcoin was down about almost 6% or so right here. And then we got Cleanspark way up, being up almost 50%, 47% up. Iris was up 23%. Riot was up 15 from 4 weeks ago, and Marathon is up 8. And then we have obviously Argo, Digihost, and Mawson. Mawson being the worst performing here, down 25.27. So I wonder, as bad as they've been doing lately, I wonder if they're coming down to their bottom basically, but we'll see if that happens. So this might be a good buying opportunity, as we're seeing that they might be way oversold here. And then if we look at the 8-week chart really quick as well, on the descending, we can see that pretty much everybody is down, but Mawson obviously is the worst performing here at 47.81% down, followed by Bitfarms 31.5%, Digihost down 31 almost, Marathon down 27.25 or so, and DMG, and then Bitcoin is only down basically 13.5%, and then Cleanspark's only down 6.2%, so they're still the one better outperforming basically Bitcoin price action, but everybody else is doing a lot worse. So I keep saying it, Bitcoin goes down 1%, these guys are going to go down 1.5 of that to 2x that, and we're seeing that actually happen here on the charts. And then finally, if we look at the 12-week chart, which everybody's going to be down quite a bit from that, let's do this descending. And on the 12-week chart here, we can see that Iris now is only down 21%. From that, Bitcoin is down 25%. So on the 12-week chart, Iris has done better than Bitcoin. And then everybody else has done basically twice as bad as Bitcoin has. And Mawson has just been clobbered here at 63%. So it might be time to take a look at Mawson. They might be way under or oversold right now. We'll have to take a look at it here. Maybe we'll take a look at the chart, see what's happening on Mawson. Now, based on this, it is looking pretty bad for Mawson right now. So here's all the miners, and for the past 12 or 13 weeks or so on the price action, we can see the green and the red. Red obviously is a change, a decrease from last week. Green is an increase from last week. So we had quite a bit of green here the week prior and 2 weeks prior. You can see here everybody was pretty much in the green here, and then things started to kind of shift a little bit where we had some up, some were down, but most of them were up last week. And then obviously this week, everybody's down except for Cleanspark. And it's kind of interesting to take a look at it. With the prior week, we obviously also had, on the week of 114, we had a mixed bag here. Mostly were up, some were down. And then obviously in December, everybody was up. But overall, we'll see if this trend continues going down or going up. The limiting factor obviously is what happens with Russia and Ukraine. That's driving it. Obviously, the media doesn't help anything because they're spreading all the fear mongering, things going on like that. So we'll see how it plays out. But right now, it's not looking too good. We'll have to see obviously how next week plays out. We may go down on Bitcoin price a little bit more, maybe go down to that below the 40,000 mark where we could go to the 37,000 and a half. And from that, we may go down even more. So we'll see. Something to be mindful of. All right. Let's take a look at the story here that I wanted to talk to you guys about, which I thought was kind of interesting. But first, let's take a look at the M2 money supply. So this is interesting. This is kind of what it pertains to, the story that we're going to cover. And we can see that obviously in 2020, when the Fed started money printing like crazy, we can see the supply go from basically 15 trillion to almost, what are we here at the peak here, at 21.6 trillion. So a huge increase in this amount of money supply that's been added to the markets. People got obviously checks sent out to them in the mail to basically spur the economy, keep everybody going, keep everybody afloat. And we might have overdone it here, I think, a little bit, which a lot of people are thinking that we did overdo it with the amount of money that was printed and given out to people, which has led obviously to higher inflation now. So let's take a look at the article here. We're going to go over it really quickly here, try to go over it really quickly. But I want to get the main points on it. So here's the headline for it. It's from Fortune. A John Hopkins economist says the Fed is totally wrong about what led to a record 7.5 inflation. And he has a bathtub analogy which explains it. So let's take a look at it here. So on February 10th, the Bureau of Labor Statistics announced that the year-over-year consumer price index jumped by 7.5% in January, the highest reading since February of 1982, and well above the roughly 6% that Wall Street expected and forecast. So economists, market strategists, and pundits argued that supply chain disruptions slowing shipments by land, sea, and air are causing severe shortages of everything from semiconductors to building supplies are the principal cause for rampaging prices, which that I'm sure has an effect of it. And we've seen it obviously not only where I work and other places like that, but everybody's affected by the supply chain. Obviously the cars, the manufacturers, Ford, Chevy, GM, all of those guys are affected by the supply. Jay Powell remains in the it's all about bottlenecks camp, right? So we've seen him and heard him talking about how he thinks that once the bottlenecks get fixed, that things will improve. So in a testimony to Congress on January 9th, Powell stated the economy has rapidly gained strength despite the ongoing pandemic, giving rise to persistent supply and demand imbalances and bottlenecks, and hence to elevated inflation. Okay, I agree with part of it. Yes, I do think that it's having a certain amount of added inflation to it, but it can't be just the only thing that's causing inflation. Obviously, we saw the money to supply go up like crazy. That's got to have an impact as well. So what if the problem isn't bottlenecks, right? So Steve Hanke isn't buying it. It's worth listening to Hanke, a professor of applied economics at Johns Hopkins University, because his forecasts have been strongly contrarian and right on. So I don't know much about Steve Hanke. This is the first time I'm hearing about him. If you guys have any insight into that, as far as previous work that he's done and things like that, I'd be happy to hear it. So the idea that supply chains are to blame is wrong. Hanke told Fortune the problem is real, but it only explains the rising prices for specific goods that are in short supply. What matters for overall inflation isn't how different prices move around inside the basket of U.S. goods and services, but the level of the total basket. Since that level is soaring, it can't be about bottlenecks. The current trend can only be explained by one force, an explosion in the money supply exceeding anything we've seen since World War II. Right, so if we look at it, money supply, we can see it here. It's gone, obviously, through the roof here. We've seen it, obviously, increasing each year, but it's a huge spike in the amount of money that was printed and given out to people. So Hanke is a hardcore monetarist, an adherent of Nobel laureate Milton Friedman's credo that inflation is always and everywhere a monetary phenomenon. So Powell dismissed it during the congressional testimony a year ago, stating that growth in the money supply really doesn't have important implications, which you can't, I don't know. I'm not an economist, so I don't know too much about it, but the more money you pump into the economy, it's going to have an effect on the economy, I would think. That's just my thoughts on that. So if Hanke is correct, the U.S. is facing at least 2 more years of gigantic price increases regardless of when the blockages ease. So obviously the shipments and things like that. So the monetarist formula nailed inflation while the Fed blew it. So Hanke insists that gouging shifts in the money supply has always been the best barometer for future inflation, but monetarism appeared to lose its relevance in the last decade plus of easy money. So we have easy money, interest rates have been going down, things like that. The monetarist approach always works, says Hanke, as long as you measure the money supply properly, and the proof is in the accurately predicted the current spike that the Fed, Wall Street, and most economists missed. What's called the quantity theory of money, the monetarism is based on, isn't really a theory. It's the truth and identity, says Hanke. It's a perfect match with the inflation America's witnessed since 1960. So that's kind of interesting. I would love to see some more data on that. So the quantity theory consists of basic formulas. So changes in the price level, the rate of inflation must equal the sum of increases in the overall money supply and its velocity, less growth in GDP. So velocity is defined by the rate at which the money supply is turning over in the economy. So the pace at which customers and businesses buy and sell products and services. So that's the velocity. Put simply, when money supply is swelling much faster than U.S. output, inflation pounds the economy. That phenomenon accounts for the family budget crushing jumps we're now seeing at grocery store checkouts and gas stations. So here's Hankey's bathtub view of inflation. I thought this was kind of interesting way to take a look at it. So Hankey likes to compare looming inflation to the level of water in the bathtub. The water pouring into the tub represents the new dollars swelling the money supply, right? So the money supply is here. This is the new money coming in since 2020. Huge amount of money coming in. Supply that new money is coming from one big faucet, fed by two sources. The first is the Fed. So the central bank sells treasuries to banks, then buys the bonds back by printing fresh trillions that didn't exist before. The second is the banks themselves. They create money by issuing new loans. Customers and businesses take those mortgages or small business credits and deposit the proceeds in their savings and checking accounts and money market funds. The banks and funds channel that liquidity into still more loans, adding to the money supply, right? So it's a never-ending cycle. So high future inflation is building and bound to leak out. When water rises in the tub, ideally, the volume that flows in drains right out, leaving no excess water. So how does that happen? The tub has two drains. The first we'll call the G drain for economic growth. The growth of goods and services absorbs or offsets increases in the money supply. The second drain is the demand for money, or D outlet. When consumers and businesses add money to their financial portfolios instead of spending it, the trend drains money out of the tub. If the amount of money going in supply equals what is being drained out, inflation will be at zero. Okay, so that kind of makes sense. So if you're pumping a lot of money in, you got both basically drains flowing through, the tub won't overfill. Okay, so I kind of get that. So what happens if more money is coming in than leaves via the G and D drain? In that case, the level of water or money in that tub rises. This excess money eventually spills over and leaks into inflation through the tub's overflow valve. We'll call it the I for inflation. So there you have it. So as the tub gets full, the money that's overflowing, that's inflation. If you don't have enough of the water being drained out of the bottom of it in both G and D drains, you're going to have inflation. So that's kind of the comparison they're making here, which is, I think, is a pretty good comparison. So the tub fills up. Since February of 2020, says Hankey, the Fed and the banks have grown the money supply by an astounding 40% or over 18% a year. So we see it here. We can see it, obviously, a huge growth, 40% in the money supply. That's a lot of money. Economic growth and demand for money drained off only 10 points of that 40%, says Hankey. Right now, that leaves 30% in excess money in the tub that still needs to leak from the I valve in the form of future inflation. No matter what the Fed does from here, says Hankey, we're stuck with this excess, which is starting to hit the I valve, and it will be with us for several years. You can forget team transitory, says Hankey. He predicts we'll be living with at least 6% inflation for the rest of this year and into 2024. So that is obviously not good news. And with higher inflation, things are obviously going to go up in price. The wages are going to have to obviously offset that as well, because employees are going to be asking for more money from their employers because everything is going up in price. So it's this kind of never-ending cycle until you actually kind of balance it out somehow. So I think obviously interest rates hikes are going to be one thing that they're going to use. Supply chains issues are going to have to work themselves out as well. But there's still just so much money that's been printed into the economy that it might take 2 more years before we level off a little bit instead of seeing the 6% inflation. I was hoping we'd be done with it this year, but reading this doesn't give me a lot of comfort, I guess you could say. So let me know what you guys think of this. What do you think about inflation? What's going on with it and stuff like that? Be interested to hear your point of view on it. And this is obviously concerning if we're going to have inflation for 2 more years. So that's tough, especially if you're looking to purchase any high worth assets like housing, things like that. This is obviously going to be, I'm trying to think what it's going to be. It's going to be basically, it's going to increase everything. So there's another article that I read that housing is going to go up possibly 12% again this year. And if inflation is with us for next year as well, we could see another 12% increase in housing as well. So right now might actually be a good time to get into housing if you were thinking about doing it, or interest rates are still relatively low. So there you go, my 2 cents on that. So thank you guys so much for watching. I do appreciate it. As always, the spreadsheets are available to my Patreon members. Those are over there. And then if you do enjoy the video, hit the like button, subscribe. It helps me out tremendously, and that's all I ask from you guys. And have a great weekend. If there's anything else that I find interesting to talk about over the weekend, I'll do a video on it, and we'll see you guys then. All right. Thanks so much for watching. Have a great one. Bye.